Welcome to Dorsey's Bank Counsel Roundtable. I'd like to introduce Nick Vleetstra, a partner in Dorsey's Finance and Restructuring Group. Take it away, Nick.
Good afternoon, everyone. I'm Nick Vleetstra. Welcome to the June session of Dorsey & Whitney's Bank Counsel Roundtable, and thank you for joining us. We've planned a 60-minute presentation for today entitled The Prudential Banking Regulators Joint Proposed Community Reinvestment Act Regulations. Our speakers are Walter Mix and Dorsey partners Aaron Bryan and Joe Delinea, all of whom I will introduce shortly. But first, a couple of housekeeping details to go over very quickly. Today's program is scheduled for 60 minutes, as I mentioned, and the materials for the presentation, as well as the attendance form, are available for download through the reminder emails that went out to registrants last Friday and again today from events@dorsey.com. As was explained in those emails, you should send your completed attendance form to attendance@dorsey.com. Certificates of attendance will be sent to those who return the completed form. In addition, today's PowerPoint deck will also be accessible via a link that we will include in the recording and survey email we send out to you tomorrow. Also, please note that we will not have time for Q&A during or after the presentation today. If you have a question for our speakers, you are welcome to contact them directly or reach out to your usual Dorsey contact. The speaker's contact information is provided with their bios in the presentation materials. Okay, with that out of the way, let me introduce today's speakers. Next slide, please. There we go, thank you. Walt Mix is head of the financial services practice at Berkeley Research Group. He's a former commissioner of the California Department of Financial Institutions, now known as the Department of Business Oversight. And he also previously served as a banking executive at Union Bank of California. Aaron Bryan is a partner in the Finance and Restructuring Group at Dorsey and is co-chair of our Consumer Financial Services Group. Aaron is a member of the American Bar Association Banking Law Committee and vice chair of its subcommittee for bankruptcy and workouts. Aaron works out of Dorsey's Minneapolis office. Joe Delinea is a partner in the firm's Finance and Restructuring Group and is a nationally known bank regulatory lawyer practicing out of the firm's Washington, D.C. and Southern California offices. More detailed bios of our presenters and their contact information are included at the end of your materials. And with that, I'm going to hand it over to my partner, Aaron Bryan. Thank you.
Thank you, Nick. Our agenda today is, I'm getting a little bit of an echo there. For our agenda today, we'll be discussing the Prudential Banking Agency's proposed revisions to the Community Reinvestment Act's implementing regulations. We're going to start today discussing the background and history of the CRA and the ill-fated recent OCC final rule. We'll discuss the current proposal and offer an analysis of reporting and compliance issues. Next slide. And next. I'm going to cover the history of the CRA. The Community Reinvestment Act was enacted in 1977, and the initial regulations implementing it were issued in 1978. The current version of the CRA regulations was issued in 1995 under the Clinton administration. The 1995 version includes the three primary tests for measuring CRA performance, with which most of you will already be familiar: a lending test, a deposit test, and a service test. There were also then significant amendments in 2005. These included the creation of a small bank asset size category and a framework that allows very small banks to undergo examination only every 5 years. The amendments also added a limited purpose wholesale institutions category and a new option for the use of a strategic plan. Also of note is that the Graham-Leach-Bliley Act added the CRA sunshine requirement. Next slide, please. There's a 4-tiered rating system to evaluate financial institutions' performance in helping to meet the credit needs of its community: outstanding, satisfactory, needs to improve, and substantial noncompliance. The regulations also required certain annual filings and disclosures, including HMDA data and disclosures. Next slide. A bank CRA rating is taken into account in a variety of very significant circumstances, the most significant of which is in a bank merger, consolidation, acquisition of assets, or assumption of liabilities transaction. However, CRA ratings also play into approvals for the establishment of a new branch or relocation of a bank's main office or branch, approval of deposit insurance for a new bank, or the exercise of extended financial services. In recent years, what we have seen is that if consumer groups object to these types of proposed expansion activities based on the financial institution CRA standing, the activities will stop until the protest is resolved. So these have a very wide-ranging impact. Next slide. I'll now discuss the recently proposed and then rescinded OCC rule. The OCC issued a rule in June 2020, which was later rescinded in December 2021. So it was very short-lived, but it did have some influence. So we'll discuss what it was and what it accomplished. Although the rule itself was rescinded, implementing guidance remained in effect for activities that were conducted during the time period of October 2020 until December 31st of 2021. The OCC rule would have made very significant changes in 4 areas of the prior CRA framework. First, by adding new requirements for delineating a national bank's CRA assessment areas. Second, expanded and identifiable qualifying CRA activities and investments. Third, instructions to OCC examiners for evaluating a national bank's CRA performance. And fourth, reporting standards that were to be developed and implemented by a national bank. However, due to the rescission of the OCC rule, the promised metrics to measure a national bank CRA performance were never published. Next slide. Importantly, the OCC rule had recognized a reality of modern financial services in the digital age. That geographic location may no longer be the singular component of a bank's core operations. The rescinded rule did not eliminate the use of a geographic assessment area, but it did add a new assessment component reflecting the digital migration of lending and deposit functions. The rescinded rule's 2 assessment schemes were termed a facility-based assessment area, or FBAA, and a deposit-based assessment area, or DBAA. Next slide. With respect to FBAAs, or facility-based assessment areas, the rule required a national bank to delineate an assessment area encompassing each location where the bank maintains a main office, branch, or non-branch deposit-taking facility, although not including ATM locations. The assessment area must include one whole metropolitan statistical area, or the whole non-metropolitan area of a state, or one or more whole contiguous metropolitan divisions in a single metro statistical area, or one or more whole contiguous counties or county equivalents in a single metro statistical area or non-metro area. Next. For larger sized national banks and non-traditional national banks that gather more than 50% of their deposit outside of their facility-based areas, they must also delineate deposit-based assessment areas. The rule defined DBAA as an area where the national bank receives more than 5% of its retail deposits, and it must be delineated to consist of at least one of the following: a whole state, a whole metro statistical area, the entire non-metro area of a state, one or more whole contiguous metropolitan divisions, etc. Next, please. With respect to the identification of qualifying CRA investments, the rescinded OCC rule provided the most potential benefit to a national bank. And that's because it replaced the lending, deposit, and services tests with a broader scope of CRA-related activities that qualify to receive CRA credit. In addition, it identified specific categories of activities that would qualify for CRA credit, some of which might not have qualified previously. This was a large focus of pushback from consumer advocacy groups. The rule included a published pre-approved list of specific loans, investments, and other activities that fall within the scope of the new CRA categories. And finally, the rule created a process to allow a national bank to receive pre-approval from the OCC for more innovative CRA-related activities that formerly may have been rejected during CRA examinations. Next. The OCC rule also introduced new terms for CRA qualifying functions and investments. First, community development investments, meaning a lawful investment, membership share, deposit, legally binding commitment to invest that's reported on the National Bank's call report. Second, the term community development loans, meaning a loan, line of credit, or commitment to lend in the loan categories identified in the CRA rule. And third, community development services, meaning the time bank employees spend volunteering as representatives of the bank on activities identified in the CRA rule and interpretive guidance. Next. As mentioned earlier, the OCC rule identified several categories of loans and other banking services that qualify for CRA credit. It also added a requirement that they partially or indirectly benefit low or moderate income communities within the National Bank's delineated assessment areas. And the specific categories included retail loans, as well as a broad scope of identified community development loans, community development investments, and services. Next. Here the list continues with some of the many examples that are included in the rule. A few notable ones include affordable housing, economic development for small businesses, financial literacy programs, and home buyer counseling. Next. An essential, although unpublished component of the OCC rule was a quantification of CRA qualified activities based on the dollar value of qualifying CRA loans and community development investments of the National Bank during the year, and the aggregate of the quantified dollar value of community development services, in-kind donations, and monetary donations made during the year. Next. Although the rescinded rules expanded the range and scope, of CRA qualified investments and activities, and those changes were welcomed by national banks, certain concerns were also identified by stakeholders. For example, the expanded identification requirements for CRA performance, including the assessment areas, delineation and monitoring, commercial lending CRA credit, and application of the direct or indirect requirement. And finally, whether these record keeping and reporting concerns remain under the proposal will be discussed shortly by Walt Mix. So Walt, before we transition to the next part of this presentation, do you have any observations you'd like to share regarding the materials that I've discussed so far?
I do, thank you very much. First of all, I actually worked on the CRA amendments in 1995. However, I should say, don't go back as a professional to when the actual law passed in the Senate and the Congress in 1977. So relative to the comments that Aaron just made and those upcoming from Joe, I would point out that the cost in order to attain greater certainty around data and more measurability pursuant to the new categories that have been created will indicate a much more complicated approach that will involve what I call people, processes, and technology. And these will be items that I will discuss at the end of this presentation. Over to you, Joe.
Oh, well, thank you, Walt. I may also mention in passing that I was actually at the FDIC when the initial CRA regulations were initially written, which means that I'm an old fogey. And it terrified the bankers back then. It continues to terrify people if you're engaging in a merger transaction now because of the impact, as Aaron mentioned, of putting the skids on processing of applications once a community group has protested you. And I think what's going to be really kind of important here that we compare what the OCC tried to do with what has now been proposed. And as Aaron mentioned, they came up with new categories. And again, in 1995, when Bill Clinton issued their regulations, they made the tests up out of whole cloth, where prior there really was nothing other than an admonition of do good, avoid evil, and tell your story to the regulators. Then we had the what are currently the regulations with a few additional amendments, and the OCC took off on its own and decided to update them without the involvement of the other agencies. New assessment areas, expanded and more specific permissible activities for which you got CRA credit, instructions to the examiners as to what to do. And I think that what was actually kind of interesting is that, as you know, the other agencies did not go along, but the then acting controller of the currency said, well, that may be the case, but we've got 90% of the deposits. And therefore, what we do is certainly more important than the other agencies in terms of taking deposits from one area and not fairly lending in those particular areas. What is important as we talk now is that the ill-fated OCC rule never told us what the metrics were going to be. And now we've got them, and this is something that everyone who is listening to this really going to have to take a look at, as well as what Aaron emphasized, which was the rule that you get CRA credit if the investment is partially or indirectly beneficial to LMI individuals and to locations. And that is a test which we will see the agencies have now proposed to walk back from. Not necessarily a good thing, and yet nevertheless, it's something which we're going to have to look at because it really does determine whether or not what you're proposing to do will result in CRA credit. And on June 3, they issued their proposal. You see the link there. And I guess the question is whether or not this is either a OCC national bank light version of what the OCC had, or whether it's the revenge of the Federal Reserve Board. And for those of us who follow these things, you may know that the Treasury Secretary is originally from the Federal Reserve Board. Her chief counsel is from the Federal Reserve Board. She is on the FDIC Board of Directors, and the acting head of the OCC, acting comptroller, also came from the Federal Reserve Board. So whether or not this is the revenge of the Federal Reserve Board or not is something which you can all determine. I think there's some evidence about the fact as to who's driving the bus at this point. And one of the things that is difficult to deal with is that with this new proposal, there's a number of new squishy terms which they have decided to come up with, which are going to govern what you need to do. We're going to talk about them a little bit. And expands for large banks, which are really not large banks, and we'll talk about that in a moment. New categories for CRA testing, the retail lending test, the retail services and products test, the community development financing test, the community development services test. And importantly, as I just mentioned, they've put in the various appendices, the metrics by which you're going to be measured and evaluated, and your CRA rating will be computed. Something really which we're going to have to pay attention to. So we're going to look at some definitions, the new assessment area delineation, qualifying CRA activities, community development definitions, standards for assessing CRA performance, and then Walt is going to talk about from his perspective, as a former banking commissioner and as a bank consultant, the myriad reporting requirements and compliance that this proposal has come up with. So let's start out with some definitions. It creates new definitions for covered banks that significantly affect compliance requirements, and there's a couple of them. First is that of a large bank, and it's really not a large bank, but according to them, yes, a large bank is a bank that has average assets of at least $2 billion in both of the 2 prior calendar years. And nowadays, a $2 billion bank, there are many, many, many $2 billion banks. And so a large bank is really, frankly, a small or medium-sized bank, but they get to write their definitions, and they did. And then you have an intermediate bank. An intermediate bank is a bank that has average assets of at least 600 million and less than 2 billion. And again, particularly on the East Coast, West Coast, there's not that many of those banks left because of the growth necessary in order to be able to show a profit. And then you have small banks, which are under $600 million. And they, in this proposal, are fortunate because just about everything that currently is in the current CRA rule, the currently effective one, still remains. And so they're going to be able to make use of it. And so many of the things which we're going to be talking about today may not necessarily significantly impact them, which is certainly good in terms of record keeping and the compliance component. Now, a couple of other important definitions. Community development activities. Here's where one of the major changes between what the OCC said was a community development activity and what they have proposed. You receive community development consideration for a loan, investment, or service where the primary purpose, not the indirect purpose or possible purpose, is for community development, generally meaning the majority of dollars are identifiable to community development activities. Now, there's some liberalizing components in here, which we don't have time to get to. But one of the things where they look like they may have micromanaged this is that if you've got an investment, but it's only partially community development qualified, the portion that is not community development qualified gets deducted from your computation. So again, they're really micromanaging this. Community development purposes, loans, investments, or services that have a community development purpose if they promote designated LMI individuals or are directed at designated census tracts and similar areas of concern. The laundry list of what qualifies is similar to what the OCC had proposed, and you can review these and you can see the fact that it's everything in the kitchen sink: affordable housing, economic development, community support services. I would also indicate for those of you that are interested, which is I think going to be an important component here, down at the bottom, activities undertaken with minority depository institutions, women depository institutions, and CDFIs. This could end up being a very favored route for being able to work with community groups and other interested community entities in order to promote community LMI development. So again, something to watch, and it is a growing activity. For example, CDFIs, there's now over 1,100 in the United States. And of course, also activities taking place on Native American land areas. Another change that came about here is that the OCC published a list of qualified activities and then also turned around and said, all right, one of the complaints is that you could never tell in advance whether or not something which didn't quite fit all these CRA parameters might not get you credit 18 months down the line when the examiners came in and said, well, we don't think that this is a CRA qualified investment. And so first of all, the OCC published the list. And second of all, they said, hey, write in and tell us, and you will know in advance whether or not you get CRA credit. One of the problems with this proposal is that it is clear that there's not going to be an OCC list. There's not going to be an FDIC list. There's going to be one list. And one of the powers in a small group of people is not the power to approve. It's the power to veto. And a concern that has already been raised is that the Federal Reserve Board may end up being very conservative in terms of its viewpoint as to what qualifies as a CRA activity or a CRA investment. And it's something which we're going to have to keep our eyes on. And as I mentioned, it abandons the direct or indirect analysis. So under the direct or indirect analysis, if you decide to put up a supermarket in a LMI area, that would give you probably CRA credit. It's unclear whether that would be the case nowadays. It also is unclear as to how the regulators will issue clarifications in this very, very important area, and how they will go about if you write in and say, we want to put up a supermarket, will we get credit? Whether it's going to be a bunch of guys sitting around a table and voting on it, or whether or not your regulator will be able to give you permission. This is something that I think the industry has got to really pay attention to. Now, assessment areas. Well, the assessment areas have, again, been slightly tweaked, and we now have got a facility assessment area, which includes any county in which you've got effectively a bank branch or a deposit-taking facility, but interestingly enough, including the surrounding area outside of the county where the bank indicates it has originated or purchased a substantial portion of its loans. So it's not only the county, it's around the county as well. This probably works for purposes of the Midwest area, not so much in the case of East Coast and West Coast. But let's turn to that somewhat goofy definition of an intermediate bank. An intermediate bank is not subject to looking at its CRA facility assessment area as being a complete county. It can delineate the portions of the county in which it does business, because it is going to be, by nature of the definition, a much smaller institution. And for the small banks, they're subject to the current CRA regulation, and they will continue to determine their assessment areas under the current regulations. There's another goofy statement in there, in that banks devoted to the military do not have assessment areas as we know them, but rather their assessment areas are defined as military personnel, which is kind of a nomenclature issue that maybe they have to clean up, but that certainly makes sense, so that if you're someone like USAA who services the military, your CRA assessment area is really where where your service personnel located. Large banks must also delineate a retail lending assessment area, which again, somewhat of a fuzzy term, which is outside of your facility assessment area, and it must consist of a single MSA or all of the counties in a single state that are outside of the MSA. And in the case of either an MSA or a non-metropolitan area of a state, a geographic area in which a certain number of mortgage loans, 100 in number, or at least 250 business loans are originated. So again, here's another example in which calculations are going to be necessary. So we are now going to focus on the large banks, because they're going to have most of the tests, and then you've got a sliding scale down to the small banks, which are not going to have much impact in terms of this proposal. So we're going to be looking primarily at the large banks and the performance tests and standards to assess a large bank's CRA performance. And there's 4 tests: the lending test, the retail services and products test, the Community Development Financing Test, and the Community Development Services Test. Now, for intermediate banks, those are the banks above 600 million and below 2 billion. There is a junior category called the Community Development Performance Standards, which is really a scaled down summary of these 4 tests for the large banks, which is going to effectively give intermediate banks more flexibility in terms of being able to argue their performance is acceptable compared to the large banks. What we also have then, as I mentioned, is for smaller banks, the status quo under the CRA regulations. And then we have wholesale and limited purpose banks. You would use the Community Development Financing Test, which I just mentioned. And for all banks, if requested, you can say, this really doesn't fit our business model. Let's do a strategic plan. And I think Walt is going to mention that as a viable option for people to seriously consider. And finally, to just confuse everything, when you go through these various categories and these various tests, if you are not a large bank, there's a permissible degree of mixing and matching of these various categories and various tests, which you can opt into in order to, if you will, fine-tune your own CRA performance categories and testing for purposes of moving forward. Now, one of the things that we don't have time for, because it would put us all to sleep and it's enormously complicated, is going through all of the standards and tests for each of these various categories. So we're just going to talk about a few, but you hopefully will see how really complicated this whole thing is going to be when it's finally adopted. Let's talk about the retail lending test. It evaluates a bank's records of helping to meet the credit needs in its facility-based assessment areas through the bank's origination and purchase of retail loans in each of those facility assessment areas. And the proposal includes major product lines, which I guess maybe Walt can talk about. Is this credit allocation? I'm not really sure, but it certainly sounds like it may be. Closed-end home mortgage loans, open-end home mortgage loans, multifamily loans, small business loans, small farm loans, and I think really somewhat strangely, automobile loans, that's thrown in there as well. Now, for the retail lending test, and this is where we probably need either Obi-Wan Kenobi or someone from Star Wars to help calculate it. A bank is going to be evaluated based upon the following metrics as described in the various appendices to the proposal. And there are standards, and then there's metrics. There's the retail volume threshold, the bank volume benchmark, the market value benchmark, the geographic bank metric, the geographic market benchmark, the geographic community benchmark, a borrower bank metric, a borrower market metric, a borrower community benchmark. Thankfully, we've got very, very sophisticated computers. Maybe we're going to need a quantum one to be able to make these calculations. And certainly for purposes of being able to identify what is going to apply to you and how these metrics interact. It is, I can assure you, it is very, very complicated when you go into the appendices and trying to figure out who's on first. Let's go to the retail services and products test. It evaluates the availability and responsiveness of a bank's retail banking services to LMI individuals and an LMI census tracts in a bank's facility assessment areas and in a state, multi-state, MSA, and institution area levels. And so it's slightly broader than the assessment and retail lending test. And its delivery systems are measured, such as bank distributions, branch locations, census tracts in which you're located, opening and closing of branches. And for banks, again, with another new category of banks over $10 billion, which are the so-called SIFIs, digital delivery systems will also be evaluated. And in the OCC ill-fated proposal, you could delineate it even if you were under that number, because millennials walk around and do their banking on their phones. It really doesn't matter where they're located. A real change in terms of the scope of what banking services are. And in this case, as in the case of the lending test, the same types of metrics are required and are included. We're not going to go into all of those. The community development financing test, it evaluates the bank's records of helping to meet community development financing needs across its entire footprint. And it relates back to the definition of community development and community development purpose. That's why it becomes important as to whether or not it's direct or indirect, or whether or not it must primarily affect targeted communities. And this is where the rubber is really going to meet the road. And also in this case, the same types of complicated metrics are included. The community development services test evaluates the bank's records of helping to meet community development services in the bank's facility-based assessment areas and elsewhere. And the community development services test is related somewhat to the OCC's rules in that it focuses in on what is the bank's employees and officers and directors and affiliated persons doing out in the community. How is it helping? And you've got numerous examples here of being on the board of directors, providing support for fundraising, providing financial literacy, providing services reflective of the bank's expertise. So helping small businesses, for example, educating small businesses. And guess what? It's got an appendix for metrics to be able to determine whether or not you're doing a good job or a bad job. Ultimately, this all ratchets up to the CRA ratings. And except for small banks, the proposal expands the rankings from 4 categories to 5. And would be outstanding, high satisfactory, low satisfactory, needs to improve, or you're in trouble, substantial non-compliance. And high satisfactory rating is not going to apply to small banks. Why they did that, not quite sure. Maybe because it would require additional record keeping. But in any event, we've now got 5 standards that we have to take a look at. And on top of all of that, and on top of all of the metrics that we were talking about in each category, then you end up with the composite rankings to determine whether or not you are going to make a composite, how you're going to meet your composite test. And it assigns ratings and percentages amounts to each of the each of the tests, which we just talked about. So the retail lending test gets a 45% weighting. The retail services and products test, 15%. Community development financing test, 30%. And the community development services test, that is the use of employees, they get 10%. And so supposedly after you've gone through the metrics and after you have evaluated them and calculated what a numeric number is assigned in each of these particular tests, in terms of your composite rating, you then apply a percentage test to each of these individual tests, and you end up with your composite CRA rating. I will probably stop here and turn this over to Walt, who's going to tell you how really complex this is and what we need to be starting to think about in order to look down the line in terms of compliance. Walt, I will hand it over to you.
So I'm this afternoon's cleanup hitter for those of you who like baseball analogies. We're almost to the All-Star game here, which is pretty exciting. Thank you very much to Dorsey and Joe and Aaron I found their remarks to be very, very cogent and really cut to the essence of the situation. I'm delighted to be with you again, and if there's a watchword for the presentation, it is indeed complicated, but I would add to that, as I mentioned earlier, it's going to be difficult to build what is required here under these amendments. And don't forget that you will also have to maintain that which you build. My background, just briefly, I've been working in a number of areas in financial services, including M&A, branch rationalizations. These are all apropos of CRA. And every once in a while, I get a call from a banker who's in the midst of an exam with his or her hair on fire, saying, please help me with the examination that's now underway. It's important to also note, in my view, that the timing for the proposal is sometime this fall. It's quite clear to me that the FDIC board is supportive of this proposal. So frankly, implementation and preparation is on the to-do list right now. I think it's also important to note that Lael Brainerd, who is the vice chair of the Fed, pointed out that the last major revisions to CRA were in '95. And I would quote her by saying, the CRA is one of our most important tools to improve financial inclusion in communities across America. So that's from the fairly recently Senate confirmed vice chair of the Fed. So along with complexity and challenges comes new opportunities. And for those of you who have expertise and or an interest in community development related banks and issues, I think what Joe just enumerated presents some terrific opportunities to team up and meet the requirements. And this would all be, of course, within the spirit of the CRA itself. Another important point to note is what Joe said. The indirect has now become direct, which is all part of this move toward making things more measurable and objective. I believe that the good old strategic planning approach, which is offered up, would make a lot of sense for many institutions relative to complying with the amendments. And I'll say why in a moment. But as I mentioned, partway through the presentation, I think of all this from the perspective of people, processes, and technology. Do you have the right people to build this out? Do you have the ability to continue the maintenance of this program over time? Or would it make more sense to have one-time costs incurred and then have people at your bank insource it and maintain it? Considering the program changes that were enumerated by Aaron and Joe, it's important to note that part of what the regulators are trying to do here is to provide for tailoring by creating these different categories, which they will provide and will set forth. They're going to try to tailor this to your business model. And so if you think about the different sizes of institutions, the list of services, I think it would behoove you to spend some time now looking at how this can be tailored to your institution. Relative to systems, do you have systems that can accommodate this? Will you have to change your systems? Of course, the devil is always in the details, and this will be particularly true under these amendments. One example would be how measurable are the activities that your bank currently undertakes. So I think it would make sense to take a close look now at what you're currently doing and think about the gaps that may exist between what you're currently doing and what's required under this proposal. And then, of course, in terms of data, I think most of us know, as folks in the banking industry or financial services industry, that benchmarking is not the simplest thing to do. And so it will take some real effort to figure out how best to benchmark your institution's services. And then, of course, we have the ever-present issues of whether your data is clean, whether your systems have been validated, and all of those are going to come into play. Oh, and let's not forget TPRM, vendor risk management. So as everyone knows, under GLB, one must have a robust vendor risk management process. And I would say that's something to think about too, as you ready for these amendments. So back to the strategic plan comment that I made. This marries well, in my view, with the fact that pre-approval of processes and of services will be accorded by the regulators. And also taking into account the timing of the proposal, it may make sense to take a careful look at whether a strategic plan may be advisable for your institution. Community groups. Joe mentioned and Aaron mentioned the community groups. And this, of course, always comes up whenever there's a merger, consolidation, et cetera. But I think they may take a careful look at whether they concur with some of the ratings that are accorded to your institution. After all, the data will be available and they'll be able to take a close look at whether they agree, and who knows, they may end up challenging some of the ratings. Also, I think it's a good time. I note that many banks are already doing a good job in terms of their ratings and in terms of their programs, and they're serving their communities well. But how this is presented to the regulators and what appears on your website oftentimes can be very important to how regulators view your institution, and frankly, how the community groups view your institution as well. So relative to this slide, where we talk about complex implementation and a wholesale revamping, just think about the criteria and the data that will have to be gathered and analyzed properly. And I would say analyzed properly by experts who understand what these various categories mean. Moving to the next slide on business loans. Think about, for those of you who are in the business of originating business loans, think about how this will need to be accomplished and retained across your platform and sorted by the $1 million criterion. For many banks, depending on where you are in the country, this could be quite challenging. To the next slide on census tract disclosure. So here in California, we have 58 counties and a population of 40 million people. Think about what this will mean in a large, diverse state such as ours versus states that may be smaller and are in the middle of the country. So that sorting process for a large institution that operates on a multi-state basis could be quite challenging, particularly in view of the fact that the census data have been recently prepared and made public. So switching to the next slide, community development loans. As I mentioned, I think there could be a real opportunity here for community development banks and those who are interested in that space, but also for banks to team up with such institutions. Note that there needs to be an activity description and an analysis relative to the particular loans and investments. And the level of detail and the thoughtfulness that goes into those documents could be very important and could, as I say, possibly be married up with a strategic plan. Moving to the next slide on community development loans and investments. Again, we see that there's an analysis required and that a direct relationship must exist between the activity undertaken and the actual credit that's accorded by CRA. And when I was working on these issues in the 1990s on the 1995 proposal, many issues came up. One of those, as Joe mentioned, was the issue of credit allocation. And one wonders, and maybe this will come out in the comment process, when all of these provisions are taken together, whether this ends up being tantamount in some instances to being credit allocation. So with those comments, thank you very much again. And back to Dorsey.
Well, thank you, Walt. I agree with your perspective, and I guess I'm less of an optimist about the fact that this is going to come out correctly. And my concern is that they, as I've mentioned a few times, they have retreated from the direct or indirect purpose test for purposes of community development. There's numerous banks that are great business banks making commercial loans, and if the incentive is to work in a LMI community and to encourage development that will add to employment, create factory work, create facilities such as supermarkets or other areas helping those communities, I think that this could end up being positive. I think it is important that the regulators, when they get together and come up with their lists of pre-approved activities, as well as the process by which you get pre-approval for a new innovative investment or activity, that they provide the banks the flexibility to do the right thing as opposed to a one-size-fits-all or very limited approach that I think would be detrimental, because again, banks have got, some banks are primarily retail, other banks are commercial, and giving the people flexibility. I also agree with your thought that if the regulators give you the opportunity, if not to develop a strategic plan, but to fine tune your plan in a manner that's acceptable to the regulators, indicating how we operate our business and how we are going to meld these CRA obligations into it, I think that would be a good result. Aaron, some comments.
Thanks, Joe. Yeah, it was a treat to hear Walt's perspective on this, having lived through so many iterations of the regulations, as well as you, Joe. But I have cautious optimism about this. I think this could present some good opportunities for our clients.
Well, we'll have to see, but we certainly do encourage our banks listening today to review the proposal, because the CRA regulations have really been changed twice in over 40-year history. And what we get is what we're going to be stuck with. They are not going to be changing them in the near future. What this ends up being, we would certainly encourage you to consider, either directly or through your trade associations, to issue comment letters indicating points of contention or ways of improving the content, as well as maybe the punctuation and grammar. But that's my own personal belief, and which I like to kid them about. Anyway, Walt, do you have any further comments? If not, we'll turn it back over to Nick.
I would just encourage everyone to create a working group internal to their institution. Make sure that you have all the bases covered along the lines of what's been described here. And of course, bring in external resources as needed to augment what you are building. But there's no time like the present to get ready for these issues, because I think the spirit of regulation in Washington, D.C. has clearly switched to being a much more challenging and rigid environment. And this will present an opportunity for yet another intrusion, if you will, by the regulators. So I would get ready sooner than later.
Okay, well, thank you, Aaron Bryan, Joe Liniak, and Walt Mix for the informative presentation. Thank you, audience, for your attendance and your attention. Please remember to sign in on the attendance sheet and return it to attendance@dorsey.com. And remember, if you have questions for our speakers, you'll find their contact information in the presentation materials, or you can reach out to your usual Dorsey relationship contact. Our next meeting of the Bank Counsel Roundtable is set for Tuesday, July 26th. So look out for your invitation, and we will see you then. Thank you very much.